A very good morning to Doctor. My name is COMMONWEALTH and my metric number is 293662. Today, I will present on the determinants of credit risk of the Commonwealth Bank of Australia from 2019 to 2023. First of all, there are the problems and issues driving in this study. The problem is the growing credit risk faced by the banking institutions due to the poor management practice and the credit-heavy culture. The CEO of Commonwealth Bank pointed out the increasing life costs and other factors that affect consumer financial availability, potentially leading to increasing loan default and credit losses. The three research objectives are to determine the internal factor affecting the credit risk of Commonwealth Bank of Australia, to determine the external factor affecting the credit risk of the Commonwealth Bank of Australia, and to determine the both internal and external factor affecting the credit risk of the Commonwealth Bank of Australia. Besides, there are also three research questions which are: is there any relationship between the internal factor on credit risk of Commonwealth Bank of Australia? Is there any relationship between the external factor on credit risk of Commonwealth Bank of Australia? And the last one is there any relationship between the internal and external factor of credit risk of Commonwealth Bank of Australia? Firstly, credit risk is used as a dependent variable in this study. Credit risk is calculated by a loan that is 90 days past due divided by the total loan of the bank. In study by Gonzalez, 1997, shows that the non-performing loans increase will increase the likelihood of bank default. Next, I will talk about the 15 variables that are used in this study. The 15 variables are included: return on asset, liquidity risk, loan loss provisions, debt to equity ratio, debt to asset ratio, equity multiplier, risk weightage asset to asset ratio, regulatory capital, leverage, capital adequacy, growth, domestic product growth, inflation rate, yield curve, and market risk. The Commonwealth Bank of Australia is chosen as a sample to conduct this study. All of the data are collected from 2019 to 2023 from annual report and other related websites. Besides, the study results are obtained through ordinary risk square analysis by using multiple linear regression analysis. Next are the three models that are used in this study. Model 1 is to answer the first research objective, which impact of the internal factor, and Model 2 is to answer the second research objective, the impact of external factor, and the Model 3 is to answer the third research objective, the impact the internal and external factors on credit risk. First is the current ratio with a mean of 0.174 and a standard deviation of 0.017. Next, the return on asset has a mean of 0.09 and a standard deviation of 0.01. Moving on to liquidity risk, the mean is 0.084 with a standard deviation of 0.04. For the loan ratio, the mean is 0.027 and a standard deviation of 0.002. The loan loss provisions shows a mean of 0.207 and a standard deviation of 0.021. The debt to equity ratio stands out a mean of 15.479 and a standard deviation of 2.151. Debt to asset ratio has a mean of 0.993 and a standard deviation of 0.01. The equity multiplier is displayed a mean of 28.357 and a standard deviation of 4.505. In terms of risk weightage asset, the mean is 0.448 and a standard deviation is 0.038. The regulatory capital has a mean of 0.010 and a standard deviation of 0.001. Next is leverage, show a mean of 5.56 with a standard deviation of 0.404. The capital adequacy ratio has a mean of 18.08 with a standard deviation of 1.86. The gross domestic product growth presents a mean of 1.96 and a standard deviation of 2.689. Inflation has a mean of 3.64 with a standard deviation of 2.604, while the yield curve has a mean of 2.4 and a standard deviation of 1.86. Finally, the standard deviations, which mean Market risk has a mean of 1.529 and a standard deviation of 0.286. Now let's look at the correlation table. This table shows debt to asset ratio and loan loss provision are significant and correlated to credit risk with a p-value of 0.02 and 0.028 respectively, while for regulatory capital and leverage show a marginally significant with a p-value of 0.056 and 0.064. The other variables does not show any significant effect on credit risk. In addition, ANOVA result shows that only Model 3 are significant with a p-value of 0.076. Next, for model summary, the highest adjusted R-square is Model 3 with a 98.6% of credit risk can be explained by the independent variable. On the other hand, the coefficient table shows that the Model 3 has a significant result. Regulatory capital has the most significant effects with a 0.046 p-value on credit risk, following by the market risk. The p-value is 0.063 on credit risk. These results are same with the study by Ahmad in 2004 and Su shows that the regulatory capital and market risks are negatively and significantly affect the credit risk in bank. In conclusion, the analysis indicates that the regulatory capital and market risks are significant to credit risk. A higher regulatory capital and market risk will bring a low credit risk. Commonwealth Bank of Australia should improve the regulatory capital to reduce the credit risk. Besides, market risks also need to be aware because of the market risk will lead to a default of bank. That's all from my presentation. Thank you.